economy remains weak and the output gap is negative. Financial flows to the commercial sector have, however, improved in recent months. The Union Budget 2021 has introduced several measures to provide an impetus to growth, including the emphasis on boosting the rural economy and infrastructure, income tax rate adjustments, GST reductions, and corporate tax cuts in September 2019. Given the evolving growth inflation dynamics, the MPC felt it appropriate to maintain status quo on the policy repo rate, but resolved to continue with the accommodative stance as long as necessary to revive growth while ensuring that inflation remains within the target. The MPC also recognized that there is monetary policy space for future action. I want to use the backdrop of the MPC's deliberations to explain how the RBI envisages the impact of monetary policy decision on reviving growth while ensuring price stability. First, it is necessary to, on this point, it's necessary to recognize that the transmission of monetary policy rate reductions has been sizable across various money and bond market segments. As against the cumulative reduction in policy repo rate by 135 basis points since February last year, transmission to various money and corporate debt segments ranged from 146 basis points in the case of overnight call money market to 190 basis points in the case of 3-month CPs of non-banking finance companies. Transmission through longer end of government securities market was at 73 bips with regard to 5-year government securities and 76 basis points with regard to 10-year government securities. Moreover, transmission to credit market is also gradually improving. The 1-year median marginal cost of funds-based lending rate, that is MCLR, has declined by 55 basis points between February 19 and January 20. The weighted average lending rate, WLR, on fresh rupee loans sanctioned by banks has declined by 69 basis points. If you recall, in the last MPC, I had stated this figure to be 49 basis points. Now it stands at 69 basis points. And WALR on outstanding rupee loans has also gone down by 13 basis points during February-December. The external benchmark system introduced from 1st October 19 has strengthened monetary transmission further. Most banks have linked their lending rates for housing, personal and micro small enterprises and to the policy rate of the Reserve Bank. During October-December, the WLR of domestic banks, both public and private sector put together, on fresh rupee loans declined by 18 basis points for housing loans, 87 basis points for vehicle loans, and 23 basis points for loans to MSMEs. These developments should amplify the effects of cumulative policy rate reductions since February 2019 and help boost domestic demand going forward. Underlying the decline in GDP growth in 1920 is a deceleration in private consumption, stagnation in investment, and contraction in both exports and imports under the impact of slowdown in global growth and trade. Looking ahead, the pickup in GDP growth in 2021 is likely to be led by private consumption, which should benefit from higher spending power on account of the reduction in GST rates and income tax rate reductions for middle-income slabs. Rural incomes would be supported by expected bumper Rabi production and recent improvement in terms of trade for the farm sector on account of higher food prices. The outlook for investment is also showing signs of improvement. The corporate tax regime brought in from September 2019 should improve the competitiveness of Indian businesses. There is some evidence from unaudited balance sheets of listed firms that the corporate tax cut has bolstered their retained earnings, which in turn is being plowed back into creation of fixed assets rather than into financial savings or cash holdings. Furthermore, the Union Budget envisages that capital outlay, excluding defense, would expand by 26.2%, which could crowd in private investment. Overall, gross fixed investment could rise and propel domestic demand, income, and employment. Sectors that could benefit from Union Budget's capex commitments are power, cement, aviation, transport and roads. The RBI will continue to be watchful of how these growth potentials actually play out. Turning to inflation, the main driver of the recent surge has been onion and other vegetable prices, as already stated earlier. Softening of onion prices has already, however, commenced with arrival of the late Kharif crop. As regards prices of other vegetables, the usual winter softening has been delayed, but potato prices have started to ease and prices of other vegetables may soften over the coming weeks. Cereal prices may also soften if destocking sales are undertaken in order to accommodate procurement of the bumper Rabi crop. On the other hand, the staggered revisions of milk prices may have a more lasting influence on headline inflation. Prices of pulses are firm, but they might remain range-bound on proactive supply management measures by the government. Overall, the greatly improved prospects of Rabi harvest augur well for food prices in the summer of 2020. One-off cost push increases in respect of mobile telephone charges and prices of essential medicines are likely to push up CPI inflation excluding food and fuel, and possible spillovers will need careful monitoring. The projections indicate that inflation pressures could ebb in the second half of 2021 and ease below the target in Q4 of next financial year. Meanwhile, downside risks to global growth have increased in the context of the outbreak of the coronavirus, the full effects of which are still uncertain and unfolding. A well-executed contingency plan may, however, minimize the negative impact of this headwind. Barring the intensification of global risks, I would like to emphasize that there is policy space available for future action. This space needs to be used appropriately and should be suitably timed to optimize its impact on growth. Although monetary policy action is constrained at this juncture by inflation outlook, these pressures should ease going forward. In such a situation, the RBI has several other instruments to address the challenges to growth by improving monetary transmission as well as by incentivizing the flow of bank credit to productive sectors of the economy. The policy initiatives announced under development and regulatory measures address these objectives, thereby amplifying the intent of monetary policy to support growth while ensuring that inflation remains within the target. Needless to add that the aspect of financial stability is always kept in mind while designing any new regulatory measure. Thus, the development and regulatory policy measures which we are announcing today, they seek to facilitate credit flow to certain sectors, reinforce monetary transmission, strengthen regulation and supervision, broaden and deepen financial markets, and improve the payment and settlement systems. As announced in Statement on Development and Regulatory Policies of January 6, 2019, an internal working group was set up to review the liquidity management framework. Based on the feedback received on draft report from stakeholders and members of the public, the framework is being revised. The framework is simplified by doing away with targeted provisions linked to NDTL. Multiple operations for multiple tenors would be replaced by one fortnightly operation at the beginning of the reporting fortnight, followed by fine-tuning operations every day as required. Liquidity operations shall ensure adequate provision of liquidity to the banking system. The corridor system remains unchanged and the call money rate continues to be the operating target of liquidity operations. Finally, the revised framework introduces longer-term liquidity management instruments to manage durable liquidity. The details of this framework are spelled out in the Part B of our statement, which is already uploaded in the website. The next announcement is with regard to long-term repo operations, which we propose to undertake. Now, since June 2019, the RBI has ensured that comfortable liquidity is available in the system to facilitate transmission of monetary policy actions. With a view to assuring banks about the availability of durable liquidity at reasonable cost relative to prevailing market conditions, and to further encourage banks to undertake maturity transformation smoothly and seamlessly so as to augment credit flows to productive sectors, The Reserve Bank shall conduct term repo of 1 year and 3-year tenors in appropriate sizes for up to a total amount of rupees 1 lakh crore from the fortnight beginning 15th February 2020, and it will be done at the policy rate. The next announcement is with regard to incentivizing the bank credit to specific the flow of bank credit to specific productive sectors. Alongside sustained efforts to improve monetary transmission, the Reserve Bank is actively engaged in revitalizing the flow of bank credit to productive sectors, having multiplier effects to support impulses of growth. Accordingly, scheduled commercial banks will be allowed to deduct the equivalent of incremental credit disbursed by them as retail loans for automobiles, residential housing, and loans to MSMEs over and above the outstanding level of credit to these segments as at the end of fortnight ending January 31, 2020. So the incremental credit between January 31st, incremental credit over the NDTL of, over January 31st, that will be, that will be allowed up to July 31st. Whatever is the incremental credit between January 31st and July 31st, that much will not be taken into account as a part of the NDTL to calculate their CRR requirement. The exemption will be available, as I stated, for incremental credit extended by the banks up to the fortnight ending July 31st. The next decision relates to external benchmarking of new floating rate loans by banks to medium enterprises. Drawing upon the experience of linking all new floating rate personal or retail loans and floating rate loans to micro and small enterprises to external benchmarks, the pricing of loans by scheduled commercial banks for medium enterprises is also being linked to an external benchmark effective from 1st April 2020. We have also proposed to extend the one-time restructuring scheme for MSME advances. In order to create an enabling environment for micro, small and medium enterprises, that is MSME sector, in its efforts towards increased formalization and to facilitate them to tide over this transition, the Reserve Bank has decided to extend the benefit of one-time restructuring without an asset classification downgrade to GST registered MSME accounts that were in default but standard as on January 1st, 2020. The restructuring under the scheme has to be implemented latest by December 31st, 2020. Incidentally, the theme of this year's Financial Literacy Week has been selected as MSME enterprise, that is micro, small and medium enterprises, which will be observed from 10th of February to 14th of February. Now, the earlier scheme which we had introduced on 1st of January, that talked of assets which were which continued to be standard but were in default. So those who could not, those loans which could not be restructured under the previous scheme are also eligible for consideration, are also eligible for restructuring in the scheme now which we are now announcing. And then the next announcement I would like to make is with regard to guidelines on projects under implementation in the commercial real estate sector. Complementing the initiatives taken by the Government of India in the real estate sector, the Reserve Bank has decided to permit extension of the date of commencement of commercial operations of project loans for commercial real estate, delayed for reasons beyond the control of promoters by another 1 year. Currently it is 1 year, so we are giving 1 more year, and this will be given without downgrading the asset classification, in line with the treatment which is currently accorded to other project loans for non-infrastructure sector. With regard to regional rural banks, we have decided to permit to undertake certain merchant acquiring businesses